Welcome to U.S. Tax Forms Coach. My promise to you, in every single explainer on this channel, is this.
By the time this lesson ends, you will know exactly what to do next. No confusion, no guessing, no wondering if you filled something out correctly. Just clear, confident, step-by-step guidance from start to finish. That is what we do here every single day. So settle in, have your documents ready, and let us walk through today's lesson together, one step at a time.
All right, here's our game plan for today. We're going to cover what SE tax actually is, the difference between Schedule C and Schedule SE, the step-by-step math, where all these numbers go next, and finally, how to avoid some of the most common tax mistakes. Okay, Section 1. What is SE tax? Let's get into the core rules of the game.
So when you work for a company as a W-2 employee, your employer handles all the heavy lifting, right? They calculate and withhold your Social Security and Medicare taxes directly from your paycheck. You probably never even see that money. But when you're self-employed, well, you are both the employee and the employer. Without an HR department to handle those taxes for you, calculating and paying them is entirely on your shoulders. And honestly, that is exactly why Schedule SE exists.
Basically, the self-employment tax is a flat 15.3%. It's made up of two distinct buckets. 12.4% goes to Social Security, which funds old age, survivors, and disability insurance. And the remaining 2.9% goes to Medicare, which covers hospital insurance. It's really important to remember this isn't some sort of penalty for being an entrepreneur. It's simply your required contribution to these federal systems, replacing the exact same taxes that normally be pulled from a standard paycheck. Now, this number is absolutely crucial: $400. If your net earnings from self-employment are $400 or more for the entire year, you are legally required to file Schedule SE. Seriously, even if you just have a tiny side hustle, maybe you're doing a little weekend consulting or selling some crafts, once you cross that $400 profit line, you are officially in the game.
And here's another huge figure for your 2025 returns: $176,100. This is the maximum amount of your self-employment income that gets hit with that 12.4% Social Security tax. If you earn more than that, the Social Security tax actually caps out. But, and you will definitely want to remember this, there is zero ceiling on the 2.9% Medicare portion. You're going to pay that on every single dollar of net profit, no matter how much you make.
Moving right along to Section 2, Schedule C versus Schedule SE, knowing your forms.
You know, the names sound super similar, but they do completely different jobs in the tax ecosystem. Think of Schedule C as your business's financial report card. It just takes your gross business income, subtracts your deductible expenses, and spits out your net profit or loss. That's it. It just figures out how much money you actually made. Schedule SE, on the other hand, takes that final profit number from Schedule C and uses it strictly to calculate the tax you owe on that money. So Schedule C finds the profit and Schedule SE calculates the tax. They're basically a matched pair.
All right, Section 3, step-by-step math. Let's break down the play-by-play calculation. Here is your four-step calculation flow, and I promise there is no advanced calculus required today. Breaking it down methodically like this turns a completely intimidating tax form into a really simple checklist. Step 1, find your net profit from Schedule C. Step 2, multiply that profit by an adjustment factor of 92.35%. Step 3, take that new number and multiply it by the 15.3% tax rate we just talked about. And finally, Step 4, calculate a 50% deduction of that final tax amount. I know, that sounds like a lot of percentages. So let's look at how this plays out in the real world.
Let's say you had a killer year, and your Schedule C shows a clean $100,000 in net business income. The IRS doesn't actually tax that whole $100,000. First, we apply that 92.35% adjustment, bringing our taxable base down to $92,350. Next, we multiply that base by our 15.3% SE tax rate. That gives us a self-employment tax of $14,140. Finally, you get a 50% deduction on that tax, giving you a $7,070 deduction to use elsewhere on your return. Seeing it laid out like this really takes the fear out of it, doesn't it?
Now, you might be wondering, why 92.35%? It feels like a totally random fraction, right? But it's actually baked into the law to protect you. See, when you're a traditional employee, your employer pays half of your payroll taxes. And crucially, that employer-paid portion isn't considered taxable income for you. By multiplying your net profit by 92.35%, this math just mimics that employer-paid portion. It essentially gives you the exact same tax treatment as a W-2 employee, keeping the whole system completely fair.
Okay, Section 4, where numbers go next. Let's follow the flow. First, let's trace the journey of the actual tax you owe. So that $14,140 from our example, on your Schedule SC, that final tax sits on line 12. From there, it leaves Schedule SC and travels over to Schedule 2, specifically landing on line 4. Schedule 2 is basically the IRS's holding pen for other taxes. After that, it makes its final jump over to your main Form 1040, landing squarely on line 23. That's where it gets added to your regular income tax to create your total comprehensive tax bill for the year. But what about that 50% deduction we calculated, the $7,070 on line 13? Well, that number takes a completely separate and super helpful path. It leaves Schedule SE and heads straight over to Schedule 1, landing on line 15. Schedule 1 is where your adjustments to income live. From there, it flows directly onto the front page of your main 1040 to actively lower your total income. And why should you care? Because this deduction actively lowers your adjusted gross income. You don't even have to itemize your deductions to claim it, and it reduces the overall amount of standard income tax you're gonna owe. Huge win. All right, final stretch, Section 5, avoiding common tax mistakes with some post-game tips.
Because here's the thing, having perfectly filled out forms is truly only half the battle. The rest of the game is all about avoiding unforced errors throughout the calendar year. Since the rules are uniquely different for self-employed folks, tiny little oversights in your daily bookkeeping can compound into massive penalties or literally thousands of dollars in missed deductions by the time April rolls around.
So let's fire off these top mistakes so you can totally sidestep them. First up, missing your quarterly estimated payments. Since you don't have an employer withholding taxes, you've got to pay the IRS 4 times a year. If you wait until April to pay your full balance, you're almost definitely going to get hit with underpayment penalties, even if you pay the full amount. Second, mixing business and personal finances. Please don't do this. It makes tracking your Schedule C deductions a total nightmare and can really get you in hot water during an audit. Third, tracking vehicle expenses incorrectly. Whether you use standard mileage or actual expenses, you absolutely must document the specific business purpose for every single trip. And finally, not maximizing your retirement contributions. As a self-employed person, you have access to specialized plans like SEP IRAs and solo 401ks. These offer massive contribution limits that can significantly drive down your taxable income.
So, I'm going to leave you with this one thought to chew on. Are your documents ready to conquer your 2025 return? We have walked through the entire playbook today. You know the threshold is $400, you understand the flat 15.3% rate, you know how Schedule C perfectly feeds into Schedule SE, and you know exactly how the math works to keep you from overpaying. More importantly, you know exactly where those final numbers travel on your 1040 so you can wrap up your return with total confidence. You have the step-by-step guidance. Now it's time to take control. Gather your documents, find your net profit, follow the flow, and master your tax forms. Thank you so much for joining this explainer, and I will see you next time.